Hello and welcome back. Let's welcome in a very, very special guest now. Mr. Murali Ramakrishnan of South Indian Bank is now joining us. Thank you so much for taking out time for us. Could you just start by what is your view as far as loan growth is concerned with the sort of rates that have come down in the system, the sharp decline that you have seen and probably the sharp rebound in growth that one has seen? What does all of that mean for credit growth?
Okay, the way I look at it is we had a very unprecedented year for the country as a whole and for the global economy as a whole. So if we actually closely look at what has happened in the first half of this year as far as Indian economy is concerned, it has had an unprecedented degrowth of close to minus 24%. And what we are actually seeing in Q3 is a little bit of revival, and Q4 we expect it to be definitely better than Q3. In all, I think we are looking at a degrowth of maybe 7 to 8% for the end of the year. This is as far as the GDP growth is concerned. Frankly, whatever was the prediction by the end of second quarter for the full year, I think to some extent has been has given a positive surprise, because we are seeing things coming back to near normalcy more than what we expected. Though it's still far away from how it would have been prior to COVID periods, but overall, I think there is a expectation that Q4 will be definitely better than Q3, and all in all, I think there will be a degrowth of maybe 7% for the full year, as far as Indian economy is concerned. So, what does it do to the banking? I mean, as far as banks like ours is concerned, we are very closely looking at what's happening in the credit market, and given that it's an unprecedented event for the borrowers, we are closely looking at how their business models are getting changed and how things are shaping up for, especially for MSME, SME kind of customers. And as far as retail is concerned, people who are in the vulnerable industries, some of them have lost their jobs, some of them have got a salary cut, etc. So when it comes to consumer lending, again, we are very closely looking at what industry, what kind of jobs, and how important is that job in the overall scheme of things. These are the things, some of the things which we need to factor in our credit understanding and in our credit growth. So I would expect that this year would be flat as far as we are concerned, maybe a very marginal growth. But with the Q4 showing a bit more revival, my guess is that next year, starting April 1, will be a far better year compared to this year.
Right. So next year should be better than, of course, the volatility that one has seen in this year. But, what does it mean? See, COVID will go away sometime. Now, the timing, of course, is a question. But, rates have come down. People have learned to live from home. A lot of people are starting their own businesses. Commodity has seen an inflation, which means a lot of MSME who operate in commodity, a lot of them do, will tend to see a revival. So what all of this means when the recovery happens, how essentially things would look?
It's a fact that interest rates are definitely going to be low. Therefore, to that extent, people who are definitely better off would look at purchasing assets at this point in time when things are looking far better. For example, if you were to really look at housing, with the stamp rates, stamping duty, etc., coming down, we are finding that a lot more registrations are happening. Many of the builders are coming out with, reputed builders are coming out with new projects, etc., which we have started actually seeing from Q3 onwards, early Q3 onwards. And of course, most of the projects are being brought out by good builders. This is on the housing side is concerned. As far as the MSME, SME is concerned, people who are able to actually survive the onslaught of COVID in the first 6 months when the lockdown happened in towards March beginning till August 10, people who have actually survived that, they are able to see revival, and definitely the pent-up demand which is there for some of their products actually starts reflecting in them going back to closer to the pre-COVID days in terms of their demand and in terms of their business activity. So we are actually finding that some of these customers are coming back with asking for enhancement or asking for new facility with the hope that they are actually able to meet up with the pent-up demand, which is now sort of getting reflected in their sales. But all in all, I think I would tend to think that this is not happening across all industries. Obviously, one needs to be cautious in looking at which industry, what kind of impact it has had in terms of their purchase of material, in terms of their demand, etc. And therefore, we need to really look at the cash flows going forward. And whichever facility they are asking for, we need to do a proper appraisal in order to ensure that we don't end up taking a bad loan, especially for banks like us. We need to be very cautious on who we are lending to in terms of incremental lending.
So just a last word as far as capital availability is concerned for the sector. You think majority of provisioning, capital raising by the sector is now behind, and you should probably see credit cost for the sector coming down?
No, you can probably look at the banking, the entire banking scenario. There are quite a few banks which are very well capitalized, and their capital adequacy is very, very good. And they have also gone ahead and raised further capital, especially taking into account the revival which might happen probably starting Q4 beginning, or maybe Q1 of next year. And also to take care of any unexpected hit on provisioning post COVID, post lockdown lifting. But banks which are in the band where their capital adequacy is in anywhere between, let's say, 13 to 15% kind of band, they are obviously looking at raising capital for beefing up the capital position, especially to take care of the COVID related provisioning which might get hit in Q3 and Q4 depending on how the revival happens in the entire economy, and further beefing up capital to take care of the growth which might start happening from 1st of April. So therefore, I would tend to think that the market has been very conducive, because a lot of capital has been raised by banking sector as a whole, and we are seeing a lot of action. In fact, my interaction with many of the merchant bankers are clearly telling that they have had a unprecedented level of positive activity.
Right, so, sir. Right, sir. Thank you so much, sir, for taking out time for us. Hope to see much more of you on the channel going ahead. On that note, we're taking a break. Coming back quickly. Stay tuned.